What up, guys? My name is Chris. This is Wheelhouse Trading, and welcome to the Wheelhouse. So, I want to talk to you about developments in the charts, things that we have to be looking at, how to handle it, give you a couple different options of what you could do, what my plan is, what I've already done to implement it, what I'll be doing early in the morning prior to the market opening with the CPI data. And I want to just go through some other things, give you some useful information. If you don't mind, hit the subscribe, hit the like, select all, make me a comment if you like, and let's get started. So first, I want to look at the indexes. Obviously, we had a big sell-off. If this is the Dow, all the indexes typically look the same, though. Let's go to the minutes and just look at the day. Okay. Now, right over here is where the day started. Okay, I woke up 3 times in the middle of the night and checked the pre-market futures. They were all green. Just every one of my stocks was green in my watch list on my phone. When I looked, they in the pre-market, even if it was 2 cents or 8 cents or $1.53, but they were pretty much green. I went to bed, woke up about an hour and a half before the market opened, and everything's red. So I'm looking and I'm like, okay, jobs data, we got some different news coming out of China. There's just a couple different FUD pieces out there. And, boom, comes down, has a little rally, down, tries to rally, but this is a lower high and it just fails and all day long. And at the end, it just tanked, okay? Now, I have been walking you through kind of what to look for in the technicals. And, as these clouds go up, it's safe to be in, we're looking at the Dow, so it's safe to be in the Dow stocks. But when the cloud closes, let me just remove this line real quick. When the cloud closes, see that big purple candle? And remember, I had mentioned, we're at a resistance. And typically, when you have that many tries on a resistance, it's dangerous. And I mentioned that. But I said we should stay in our Dow stocks until this closes, okay? And if you back it up, say on the 1 hour to get a zoomed in look, you see basically a triple top. Boom on the resistance. Boom. Or it's almost 4, actually. It comes up there. But again, look, red. And you would have been out if you were trading on the hourly. But I want to show you on the daily so you get kind of a macro picture. Okay, obviously you're in an overall downtrend under the 200 red ribbon, but there's going to be these rallies. Now, I have seen it 100 times where a cloud gets a big purple candle, doesn't close, like this is not closed, okay, it's still open, and then all of a sudden it fires up. I've seen it a lot of times. Most of the time, when it starts to close, it follows through and does close, okay? And when that happens, you want to be extra vigilant, okay? So as the indexes were coming down and this candle was printing, I was letting everybody know in the Discord and making alerts, guys, you need to pay attention to your indexes. Guys, the indexes are closing. Pay attention to the cloud. Guys, tighten your stops. Guys, wake up early prior to the CPI data, and then I'm going to express what I've done and what my plan is, and just to kind of let you know, you can do what you want. But typically, if the cloud is closing and you establish a pivot, especially off a resistance, just like a bounce off of support, same thing. Instead of bouncing off of support, you're rejecting off a resistance. You see a pivot, and the cloud is closing. It's time to change directions because we are momentum based, pivot to pivot, directional traders. Okay, so when you see the pivot and you see the cloud close, you want to do a few things. You want to get into defensive mindset. Okay, so I don't have a lot of Dow stocks myself at the moment. I don't have a lot of stocks at the moment, and more than most of them are green. Hold on. On the wrong page. Most of them are green. There's a couple that are red though. There's one that's pretty dirty. It's down a bit, but most of them are green. And so this is what I do. When I see the pivot, and obviously yesterday, all these green ones were up more, okay? That's okay. You're never going to sell perfectly at the top. The thing is, you want to hold on to your gains, and now it's time to make a decision, okay? You know the cloud is closing. You see the rejections. You see the pivot and direction is changing. So what do? You have a couple options. Number one, you go and you check out your stocks, okay? So I have CRISPR right now over here, and CRISPR has been doing amazing. I'm up on CRISPR 23.37%. I have 500 shares at a profit of $6,740. It went down a little bit today, lost about 1,000 on it today or something. But look, it's been in a descending pattern for a very long time. Right there, came all the way down. Finally got his blue, got his green triangle, volume's coming in, momentum is there, you're getting your blue ribbon, another green triangle, you're at the 200, and you had a breakout of the descending. We got to make a choice, okay? This thing has come down a lot, and also if you notice, when it came down, it bounced, and it bounced, okay? So do I take the profit of the $6,740, or do I just tighten my stop, okay? So right now I have a stop on all of these. So what I'll do is I have two options. One, I tighten my stop, which I already did when the markets were falling, okay? I gave myself enough wiggle room to get to tomorrow, but I'm still, if I get stopped, I'm being stopped in the profit, okay? And what I do is I back it up. So you can do it on the 4 hour or the 1 hour, okay? And you can kind of choose a pivot low. And I like to use the ATR indicator, the average true range. It'll give you the last 14, it's the last 14 days or last 14 4 hours or last 14 hours or last 14 minutes, depending on what time frame you're on, okay? Now, I just noticed something. On the 4 hour, it's actually looking like a rejection, which now is making me think, I'm up pretty good. It looks like it's actually being rejected, and the index that it's in is starting to tighten on the cloud on the daily. So tightening that stop was a very smart idea. It's not good to be greedy and work within emotion and hopium. It's good to use logic and these technicals. And if it's being rejected and you're profitable, even though you think it probably will go higher, well, sometimes they go higher, but they got to come down first. And sometimes you just sell and take your profit, let it come down and rebuy, and then do it again and again and again, and you compound your money. So as I'm making this video and as I'm looking at this, I already have my my stop in there a little bit lower, okay? It's down in this range right here. Actually, I think it's a little higher than that. I only gave myself like a $2 wiggle room. Let me see. Yeah, it's up here. It's up in this one. So yeah, if it comes down, I get stopped. But here's the thing, in the morning, I get to read the CPI data before the market opens, right? Everybody does it. It's going to come out 1 hour prior. Now, a couple things about CPI data. Number one, when there's a Fed pivot is when the market's really going to change direction from the overall downtrend, okay? It's going to, let me just go pull up the index again for you so we can look at it. So we're in this major like downtrend, and yes, we're going to have rallies, and yes, we're going to trade it, but we got to go pivot to pivot directionally. So until inflation really comes down and everything settles, the market is never really going to be completely happy, okay? So that's why you have to be extra vigilant when trading under 200, under a red ribbon, and you need to go pivot to pivot and have a system, okay? And when the system and the process and the rules say, hey, when this closes, you need to get out, take your profits, tighten your stops, or throw on hedges, which we're going to talk about as well. And you can make your choice of what you're going to do. I believe I've already made my choice in my head in the last hour, and I believe I will tell you in this video what it is, and I'll explain why that reasoning is. So So if CPI data, comes down, which it just might not come down as much as the market wants. But the market has to understand, and the market should understand, that when they tighten and they go into a tightening policy, okay, and they tighten rates, it typically takes about 6 months of the rate tightening for it to really show up in the economy and in the CPI data. Now, they started raising in March. So you have March, April, and June, right? And that's only 3 months. That's only half the time. So last time it went down from 8.5 to 8.3, I think. Maybe it was 8.2. I thought it was 8.3, something like that. So it went down a tiny bit. I would say it probably will do something similar this month. It'll come down a little bit. It maybe goes from 8.3 to 8.1. The market won't feel that that's good enough. But again, you have to understand, excuse me, you have to understand that when they tighten the rates, it takes time. It's a process, and it is not going to be down at the target rate of 2 or now 2.5, which will soon be 3, and whatever. But it won't be coming down as fast as the market wants, even if it comes down, which will be good if it's coming down. But when you have extra issues going on with famine and with the people of Ukraine, and you have still supply some issues, and energy is still going up, and you have these indicators which basically lead you to the conclusion or the discovery of that we're still going to have inflation. Don't get too excited that it's going to be, it's going to change directions on you. It could happen. I've seen it happen. But you have to take all the probabilities into consideration, okay? And when this happens, you need to make a decision. Now, let's just look 1 month back, okay? 1 month back was right here, this candle right here. We were already trending down, okay? The CPI report came out and boom, small rally, lower low, lower high, finally caught a rally, which I've walked you through, and here we are, a pivot, and we need to look at our rules and conditions. I'm putting you on notice right now. I've been walking you through the process. I've been walking you through how to run the rallies in the bear market, but be very vigilant and vigilant with your exit strategies, okay? Now, I have charge point over here. I'm up 21.77. I think I was up more than that yesterday. NEO, I'm up 16.03. I'm pretty sure on NEO, I was up well in the 20 percentiles. BABA, I think I was up like 17% on BABA. I'm only up like 9% right now. And there's several like that, okay? I have Starbucks, and I have a couple different ones. But what I'll do is I know what my stocks, what indexes they're under, and I will see if the daily cloud closes, okay? And if it closes, I go look at the stocks and I assess it. But before all that, I already put the stops on tight, and I went to the 1 hour pivot low. It gave it a little bit of a pad just in case, because it will be extreme. It will be violent. It's either going to launch up or it's going to launch down. And a lot of times, and I want you to know this, a lot of times what happens on the CPI data day is there is a big trick that's played, okay? So it goes way up and then it comes way, way down hard. And I've seen that happen multiple times. Also, you guys know I'm good at pattern recognition. Also, I notice about 6 different times now that after the CPI report comes, it'll go up and it'll go down. It'll continue to make down days. And then what'll happen is, value come in, prices are good, dips will be bought, these kind of regular things will happen again. And, maybe there'll be some positive catalyst, or people will want to dip their toe in and they'll jump back in and we'll get another rally. not making another, not making a pivot swing high trend reversal, but just, a rally. And we essentially, just get back in. So what I'm going to do is I'm going to read the report in the morning, and if it comes all the way down into the sevens, I'm going to just leave my stops where they're at. If it is just bad and it came down 1/2 or something like that, like it did last month, I'm and I tell you guys, I don't like to buy or sell anything in a market open order. I like to wait 30 minutes. But I'm up. I have quite a bit of profit on these ones right here that are open, and it's just kind of like a knucklehead move for me to, have hope or be emotional and think things are going to go up, because I just know that the markets are the way the markets go. And if the indexes come down, red tides will sink boats, and the stocks are the boats inside of the tide, right? So I probably will, if it's bad, I'll just sell them. Okay, and yes, I was up more yesterday, but it's better to have all the principal and all the cash. Okay, then what I'll do is I will come over to my list of triple leverage bears, which was hella good today, and I will get down and dirty again. And remember, this is how I made so much money, guys. On when these clouds went purple, I ran these. Remember, I was telling you, I made like 400 grand here. I made a lot of money on these, okay? And so if you notice, triple leverage, that means every dollar goes up, you're making three times the amount of money, okay? So you want these when stuff is coming down. Now you can use it as a hedge, or you can just use it as a play. So my plan is, I have the stops on there. If I read the report and it's pretty good and I don't know how the market's going to react, I'm just going to leave the stops open, and I'm going to wait and see. Maybe it goes up, and then when it starts going down, I'll just sell, maybe get a little bit more profit out of it. If it's really bad in the morning, I'll just market open, sell, and I will immediately start putting these on. And the ones that I really like, that I make a lot of money with, are these ones. SQQQ, that means that you're betting the NASDAQ will come down. TZA, you're betting the Russell will come down. SDOW, you're betting the Dow will come down. And what am I missing? Russell, Dow, the SPY, SPXL. I don't have either of the ones I use in here for some reason. Okay, so I use SPXU and SPXL. They're both good. Let me tell you the difference. SPXL is a triple leverage. Okay, so if I click on it right here, you probably can't see, my head's in the way. I don't know if you can see or not. Hold on. If you can see this right here, it says S&P 500 Bull 3X shares, so it's triple leverage. SPXU is Pro Shares Ultra Pro Short S&P, so it's not triple leverage. I just prefer to use triple leverage and go 3 times as fast. That's just me. It's more dangerous, but for me, it's not. For me, it's not more dangerous. I don't have problems using leverage and then triple leverage in a bear market, because I know how to get in and out, and I'm comfortable with it. But I wouldn't do that if you're not comfortable with that. It took me a long time to be comfortable with doing this particular thing. It's quite advanced, but this is what I do: is I grab SPXL, TZA, SDOW, SQQQ, and then remember, if biotech is going down, like you go over and you look at the sectors. By the way, all 11 sectors were down on Thursday. If biotech's going down, LABD. Okay. If semiconductors are going down, SOXS, okay? Some of the ones I really like is actually, if financials is going down, FAZ. I really like this Webs, and I really like this HIBS, and I really like this TEX as well. Basically what I do is I'll take all that principal and all that profit from the green longs, okay, if that's what I have to do in the morning, and I will just immediately apply it into these and directionally change off of the pivots. Okay, like we talk about just about every video. So, as an example, we're on the daily. This is the NASDAQ. We had a rally, okay, and we're pivoting. Okay, now that we're pivoting, we're going to take our profits and we're going to immediately put a lot of money into SQQQ. Because if this goes to a green cloud, instead of the 5 to 9 cross, you're getting the 9 to 5 cross, which means you're going to get the purple cloud. And if you get the purple cloud, you're coming down. You're now in another downtrend off the rally, in an overall downtrend. And like I say, if you're going up on the hourly and it shows strength on the daily, your probability is higher. Well, if it's coming down on the daily and you're trading like the hourly, the probability of making a lot of money going inverse or reverse, either short or inverse triple leverage hedging, is going to be significant gains. I've made more money this year than I've ever made in the stock market, and it's been in the bear market because I've been triple leveraging with margin. Okay, so remember, you know that saying, you take the stairs up in the bull run and you take the elevator down, or something like that. Well, in a bear market, things go down 4 times as fast. So then you use triple leverage. So 4 times 3 is 12x. Then you use margin and you're 24x. So if you know how to do it, you can clean house. Super dangerous. You got to know how to do this properly. Do not do this unless you understand what you're doing. Okay? Do not do it. I will repeat, do not do this on your own unless you understand exactly what you're doing. Okay? But if you do, this is a super savage, advanced thing that I do, and I make a lot of money doing it off of the pivot reversing back to the downside directionally. Okay. Now, your MACDs are not closed on your indexes, but the MACD is the last of all the indicators, and all the other indicators, well, not all of them, but they're all showing signs of weakness. And the one that I pay attention to, that's the tightest one, is showing that it's going to come down, okay, on the indexes. And I take that particular one very, very serious. I'll show you what it is just to give you an example. Okay, follow my mouse and follow the dotted lines. When the blue line crosses over, okay, this thing is hella accurate, and I have very special settings on here. They're not default. When the blue line crosses the purple and it goes up, watch the price action, okay? And when it stays above until it crosses, you get out, okay? This has already crossed down, okay? Let me show you. This has already crossed down. And when that crosses down, that is the first tightest, most accurate indicator with the settings that I have. It's really never wrong. And if you could robotically just, buy and sell when that happens, and again, I am a big fan of trading on smaller time frames. The daily is just crazy in bear market. It's very hard, but I like to use the daily to watch the overall cloud and the overall trend, and I measure that into the probability of my decision making. Okay. So what I'm saying is, it looks like we're pivoting directionally to the downside. We need to make decisions. What I suggest and recommend, not financial advice, is you tighten those stops. Go back to the hourly, find the last pivot low, maybe use an ATR, give yourself a little pad for those liquidity wicks. You never know. It is extreme and violent on CPI day. And if you get stopped in the profit, that's cool, okay? You have your money safe. And remember, you're trying to always make money, and you're trying to protect your money by using risk management, stops, as well as capital protection, and be non-emotional and sell on the profit. Even if you had more money in there the day before, like I did on BABA and almost basically all of them, I think. I only have 1 or 2 stocks that was green on Thursday. And one of them was a triple leverage bear, which is betting the real estate market's going to come down. And I want to talk to you guys about that. That's why I'm selling my waterfront estate. I paid cash for it, and it's gone up over $1 million in the last 2 years. I do love it. Emotionally, I really love it. My daughter loves it. My girl loves it. We all love it, okay? But, I'm going to walk you through the Fed playbook of what has happened every time that we've had a high inflationary environment and they've had to put us into a recession. I'm going to walk you through the exact playbook, and I'm going to detail out the similarities and the steps that the Fed does. They won't tell you what they're doing on TV. This is just for people that like really know like what's going on. I'm gonna put it on the screen. I'm gonna walk you through the steps, and you can kind of listen and say, oh yeah, that is happening. Oh yeah, that is starting. They're starting to talk about that. Oh yeah, that is. Oh, that does make sense. And you'll see, and then I'll break down the timeline and how this thing works. Okay, now I have a lot of experience on this topic. Okay, this is what I went to school for. Plus, I have lived through this, and I have a tremendous amount of knowledge on this topic. So, when it comes to, I was able to tell you the stock market was coming. Then I was telling you at the end, all roads are going to lead to people not buying. Well, what happened on Walmart and Target? Consumer demand is slowing. Then I told you they were going to slow down hiring. Why? Because the Fed wants to slow down demand. Why do they want to slow down demand? Because velocity of money is one of the components of inflation. M times V equals I. Money times the velocity of spending, going out for sushi, going to the movies, buying video games at GameStop, whatever, spending money, equals I, inflation, okay? The Fed has got to slow demand. They can't speed up supply necessarily so they can work on demand. And I'm going to walk you through the playbook, and it should really make sense if this is kind of the first time. I think a lot of people, are really, really doing a good job of talking about this stuff on YouTube, but I'm not sure that they're breaking it all down in one video. However, I've watched a really big YouTuber, and he's doing a great job of explaining it piece by piece in videos. And he's right. But I'm going to just kind of detail it out in like one video, so it's just like step by step by step what the Fed does, what their playbook is, how they've done it before, how we get out of this situation, and what happens during it, and how much longer you have to, kind of deal with it, okay? So I'm going to do that in this video for you. So look, the cloud's closing on the daily, coming into CPI, and the CPI outlook is probably not looking that good. Even if it comes down a little bit, it doesn't mean it's going to make the market happy, and the market's not going to be happy until the Fed slows down on rate hikes or inflation is much, much lower. And it's going to take a long time, guys, for inflation to come down. In the Wheelhouse Wednesday, I was explaining to the guys, I was like, it surprises me, all these economists and these strategists and the CIOs on Bloomberg. It kind of surprises me how, back here they're like, oh, no, you don't want to be in cash. And, oh, yeah, you want to DCA. And oh, we're going to buy the dip. And meanwhile, I'm over here saying, no. You get out. Like we're topping, it's bubbling. Like the volume is expanding. I talked about it in the other videos in depth, but I was letting everybody know to get out, and it's because I could see certain things in the technicals. Now, what I hear on TV them saying, but I was seeing $5.8 trillion in distribution money coming out of the markets. So when they're saying no recession, don't be in cash, buy the dip, but they're doing the opposite behind the scenes, they're doing that because the people that are watching it are retail. It's you, it's me. So you can't always believe what they say. And right now, all of a sudden, as of 2 days ago, you have all these chief economists and global strategists and CIOs all saying, well, now there's a very high chance of a global recession. And as of yesterday, Bloomberg said 75% of all the CEOs of public companies in a poll have said that recession is on the horizon. Now, why are they telling you that 7 months after I told you that it was going to happen? Do they not know? Are they not experienced? Or do they know and they're lying? I'm actually going to give them the benefit of the doubt and not call them dumb. I'm going to tell you why I think that. I think that they are smart. I think that they do know what they're doing, but I'm going to tell you that they're lying to you. So when they're like, there's no recession, and they're pulling the money out but telling you the opposite, well, the only way that manipulation can be found is in the volume on the technicals, okay? And I'm good at that. I'm good at seeing that. And that's helped me tremendously in my life, and I highly recommend you learn about volume in technicals, okay? But when they're saying the opposite all of a sudden, And I do agree there is going to be a global recession, and I'm going to walk you through, the reasons why in the playbook, like I said. But I am now seeing accumulation in the volume, and I'm seeing it across a lot of sectors. Is it heavy, substantial accumulation? No, but there's chunks, there's nibbles, and the volume is increasing, and you saw that during these rallies, and you can see it in stock charts, all kinds of stock charts, all kinds of sectors. So yeah, there are people accumulating down here, but you have to ask yourself, am I a BlackRock? Do I have trillions of assets under management? Am I a Vanguard? Can I sustain, can I afford to be down here and wait the length of time that this thing could take to come back to even? Remember, we don't want to buy the dip. We don't want to average down. We don't want to buy a falling knife. We want to establish floors, and we want to definitely buy off the bottom and become wealthy and do a buy and hold through a bull run when we get to the bottom. In the meantime, we just trade the bear market in and out with tight rules. Okay, that's all we do. Okay, anything else, it can be very damaging. Like, I'm profitable because I knew how to enter, and I'm going to exit, and I'll either let those stops get hit in the morning and lose a little bit more, which is fine because I'm still profitable on my stuff. Look, 23.37%, 21.77%, 16.03%, 8.63%, 8.41%, 7.20%, 7%, 3.39%. Like, these are profitable. So it's more money than I had when I started, even though I had a little more yesterday. So I'm okay with that because I'm about holding on to my gains. Now, and I know that if it goes up and comes down, I can leverage bear down, and when it changes again, I can close those, and I can bear market rally the next momentum, pivot to pivot up when there's strength, and do it again. Okay, and I'll go through my charts and I'll make my selections, and I'll do that, and I'll do that for as long as it takes until the real bottom is established, and you will know when it is, because this thing won't just be this little guy. It'll go up and just down a little bit, and it'll start really moving up for you. My prediction is that the Fed, basically the Fed, we had a pandemic, which is an anomaly, okay, and it's different than, it's not normal, okay. And during the pandemic, they stopped the economy. Okay, they told restaurants to close, people to stay home, people to get off the freeway. I mean, everything from restaurants to bookstores to, of course, if you were e-commerce like Amazon, you did great, right? But airlines and Airbnb, all kinds of things were closed down for us as consumers to go and enjoy services. Or even, maybe buy products. If, again, e-commerce is different. But all the staff as well. The staff had to stay home. Now, so they closed down the economy, and then they injected stimulus to all the people because they weren't working to, be able to buy some food and do some different things. And then they injected more money into the PPI program for small businesses. Okay. But during this time, as the market was propped up and we went on this magnificent bull run, okay, inflation happened. And this is where I think, and I've mentioned in multiple videos, I think that it will revert back to the peak prior to COVID, which is right here, okay? And I think that we're just going to kind of do this deal where we go up and down until finally we get there, and then we kind of go sideways, and we start doing the opposite of this, and we start building this base and eventually get back to a bull run. But a lot of things are going to happen in between now and then. So I'm going to grab a text tool, and I'm going to walk you through the Fed playbook from the early 40s, the late 60s, when we had high inflation, a hawkish Fed in Vietnam, which went in all the way into like 72, where we had the OPEC oil embargo, and the Nixon Watergate scandal. That was a big time like this with inflation, and obviously after World War II, and there's been other times, but it's from the playbook. So this is how I'm just going to walk you through it. Fed playbook. Okay. The goal to bring down inflation and protect the world reserve currency. Okay, people aren't talking about that, but this is actually the goal because it is so important for the Fed to protect the world reserve currency. So let me see if I can make this a little bit better for you here. Bring down inflation, and we'll do it like that. Okay. All right, so that's their goal. Now, they have a dual mandate, okay? Their dual mandate is to bring down inflation and to bring back price stability, okay? That's their job. Their job is not to make your stocks go higher, not to make the crypto market go higher, not to make the real estate market go higher, okay? So, obviously, they have a tricky job. It's tricky right now because, like everything, in life, everything goes way up in the pendulum of hope and excitement, and it comes way down below to fear. I'm throwing in the towel, and it reverts to the mean, the 200, which is the line in the sand, and above the 200 is bullish, and below is bearish, and we're talking about stocks and crypto when we are talking about that. With real estate, it's different. It reverts to the 10-year mean, which is the average price of the last 10 years, which is about 50% lower than it is currently. Do I think that the real estate market is going to drop 50%? I don't. There's different dynamics in play. I do think that the real estate market is coming down, and it is a slippery slope, and I'm going to walk you through that. That is why I am selling my multi-million-dollar estate. And sorry about this little misspelling here. Put the D in there. Okay, so the playbook is a dual mandate, inflation and price stability, and people can't afford homes, and they have to bring down inflation, and they have two choices. They can not raise the rates, let inflation run hot, probably never get that genie back in the bottle and destroy our economy, and definitely the world reserve currency, because they will debase it and devalue that. They cannot risk that. The lesser of two evils is to raise rates, crash the stock market, cool down, possibly crash the real estate market, freeze the hiring, slow the demand, the velocity of spending, which will help on the process of lowering inflation. Okay. Now, what they decided to do is raise the rate and try to get the genie back in the bottle while there's still some light at the end of the tunnel, and it's a possibility. Okay. Drastic measures, they got to do it, but they gave us guidance. Okay, so we know quarter point, they did a quarter point. They said they wouldn't do 75 basis points, they haven't. They said they were going to do a half a basis point, or 0.5, and they have. And they said they're going to do it for 2 more times, and they probably will. So we'll take that guidance at Jerome Powell's word right now, so we know kind of what to expect, and I do like that, and I'm happy for that. Now, if they change it, it's going to rattle markets. So, number one. They crash stock and crypto market. I want to talk to you about that first. I'm going to walk you through the playbook. Listen, watch to the end of the video. You're going to learn something that you'll know for the rest of your life. I know a lot about this topic. This is pretty much the order it goes in, and you'll kind of know where you're at in the phase and what to expect, okay? So the first thing they do is crash the stock and crypto market. Now, they do that because they need to pull liquidity out of the market, okay? Now, they put the liquidity in, it made inflation, they have to pull the liquidity out. It's part of the deflationary process. Now, 2 things happen in this particular moment pertaining to pulling liquidity out of the stock and crypto market. It's phase 1 of the Fed playbook. Okay. What happens is 2 things. You either panic sell and you never have that money to spend, or you have less money to spend because you panic sold at a loss, okay? That's good for the Fed because now you have less money. So now in your mind, you're not going to sushi as much. You're not going out. You're not going to Vegas, spending $5,000 a hand on blackjack, whatever. So you have less money because you panic sold. So that works for them if that's the choice that you made. Number 2, as they crash the stock market, you decide to hold, and it takes a long time for this thing to come back, and that's also good for them because you can't pull it out because you're in a downtrend and you're in a waiting and holding pattern. Therefore, you have less money. Therefore, the velocity of spending is lower. Playbook number one rule: crash the stock market, crash the crypto market, pull the liquidity out. Okay. Now, they want you to be to have less money. Okay, right now, because if you have less money, you're spending less. And remember, money, making money at a job or in stocks or in real estate, with V. Okay, the velocity of spending, going out, just balling, spending money all the time on whatever you want, just getting the economy booming. Is 2, and that equals inflation. So if they remove one or two or both, it helps their process for deflation. So they're going to pull the liquidity out and crash the stock market and crypto market. I told you guys this back in November. Here we are. I went back and I was watching those videos, and I was on point and letting you know about this way back here. Okay. Now number two. What they want to do is when they pull the liquidity out, they want to slow consumer spending. Okay? Now, again, slowing consumer spending slows the velocity of spending. Okay? Now, a good example of this is recently Walmart and Target came out on their reports and they said, people are not buying home goods as much, and they're buying the white label products instead of the name brands, and so you're starting to see that on some of the premier retailers. Okay, and like I said, and we'll say again, all roads end when the consumer, you and me, decide we cannot afford the rent, we cannot afford the bread, we cannot afford the diapers, we cannot afford the gas, and we just put our hands up and we quit our job and we move out of the city, and that's where all roads end. And that shows up on the Walmart and the Target and all these other ones, and I'm gonna unfortunately paint a little bit of a gloomy picture because it gets more gloomy as we go. Okay, so as you start seeing the slowing of consumer spending, that is coupled with another problem. The problem that we had a pandemic, which is an anomaly, and that created supply chain issues. We get a lot of our supplies from China, and we get some from Russia. Now, we have the Russia-Ukraine war, okay, and we have COVID lockdowns in China, and we have shipping, and we have a lot of problems. So a lot of these big companies, whether it's NVIDIA or Ford or Tesla or any name you want to pick, they have said on their earnings reports that it has been tricky, at the least, if not quite difficult, to get supplies. And over-ordering has taken place, which is glut. Okay, and again, Target came out and said, hey, we have over-ordered. We have paid exorbitant amounts on shipping, whether by boat, speedboat, plane, or rail, or trucking. We've paid higher shipping, okay, which eats another margin, and we've paid inflated prices on the products that we are wanting to put on the shelf. So they've paid high, they've over-ordered, and now as supply chains ease up and loosen up, they have to fire sell that stuff probably at a loss, okay, because they paid higher shipping and they over-ordered and they paid higher a higher price on the product because the demand is through the roof. All right, supply and demand. So when there's less supply and high demand, prices go up, and Walmart and Target are great examples of this, but it's all of them. Okay, every one of them, Apple, Microsoft, you name it. So there's glut. Now they're going to sell this product at a loss or a break even, probably a small loss. And how do they offset that loss on their quarterly earnings? Because it's going to show up on the quarterly earnings everywhere on all the stocks across the board, minus a few anomalies that do really well. But for the most part, it's going to show up, and that is going to decelerate the stock value, and the indexes will keep coming down. And so the one way that they offset, I don't know if you've owned a business, I've owned a lot of successful businesses. The one way you offset a situation like this, when you over order and you have to reduce margins and show statements to the public, and that's going to be a problem, is you do layoffs. You freeze hiring, okay? So you're going to freeze hiring. You're going to have less people. You don't need to bring more people in because the demand is slowing, because the Fed wants the demand to slow, and they are slowing it down by lowering your stocks and your crypto and soon to come your real estate and then your layoffs, and people will have less money because the velocity of spending is a key component of inflation. It's part of the process to deflate, okay? So you see on TV now, like I've been saying, that Tesla, Twitter, Snapchat, Google, I mean, there's a gamut of companies that are freezing hiring, okay? There's less demand. And eventually, there becomes less demand, and they have to offset these quarterly reports, and they start doing layoffs, okay? Now, this is when you are basically starting to feel like everything is really bad. You got your 401ks, you got your liquidities being pulled out of the market. You either sold at a loss so you have less money to spend, or you're holding and you can't sell yet because you're waiting it out. So you're spending less and you're just waiting. The consumer demand is slowing, and what you got left though is some hope, because you have your real estate, okay, that's gone way up, also very inflationary. And something that I want to tell you that's a fact that I don't see many people talking about is home prices run with inflation, okay? So when inflation goes up, home prices go up. Same with stocks, okay? And when inflation comes down, stocks, crypto, and real estate comes down, okay? That's just an indicator, okay, if you didn't know. Now, 4 Fed presidents have come out on the news, and they said that now that they have the stock market down, they need to cool off real estate, okay? So if people think that their hope is that they still have money because they have their job and they have real estate, well, unfortunately, the Fed, this is part of their playbook. It's all of this is a process to bring inflation down, and it's a multi-system, okay, from raising the rates so less people, apply for mortgages. Right now, mortgage applications are down 75%. Mortgage originations are down 58%. In the county that I live in California, demand has slowed by 64%, okay? In 1 month, guys. It's changing quickly. And so what happens is you have the hope, okay, but now it's harder to get the job, okay? And even though the president ran on this white hot labor market, even though there's 16 million jobs open, and then talking about the white hot labor market and there's still 11 million job openings, he also came out and said, well, I don't really want to explain to the American public of all the intricacies and mechanisms that we have to do to slow the hiring process at these large companies. And Jerome Powell and Biden both came out on television, and I saw it come out of their mouth, both of them, that they want large companies to freeze hiring. Why? It's part of the Fed playbook. It's they can control demand. They're working on demand, and businesses, CEOs are going to want to freeze hiring because they're not going to need as many people because the demand is going to start to subside, and those earnings are going to show it too, which will create additional deceleration. Okay, it's not over. All right, so freezing hiring and then layoffs. So people start to lose their job. Good people, okay, people that have 800 credit scores, people that have some money in the bank, people that don't have money in the bank, that don't have good credit, people that have 5, 6 kids, 3 dogs, 2 cats, and no family. It doesn't matter. People get laid off, and it's horrible. And when people get laid off, unemployment goes up, okay? And the last thing that people have is real estate. They say, well, okay, I'm going to sell my home, and I am going to, that's how I'm going to, live while I go find another job, okay? But what happens is, as the stock market and crypto market comes down, people feel they have less money. And then they spend less, okay? And then there's the freezing and the layoffs, and hopefully that doesn't happen to everybody, but it typically happens to a lot of people. And then they start selling their home. So I'm selling my home, but I'm trying to do it. So my house went up in, what month are we in? June, so May, so April. In April, it went up about 125 grand. In May, it went up 324 grand last month. Okay, when June comes out, it'll probably still go up less though, and then it'll probably still go up the next month, but less. And it's a luxury estate, so it's a little different than the median homes across the nation. And it's waterfront and whatever. But eventually, what's going to happen is when people get to the layoff and they feel that they don't have as much money to spend, then people are going to put signs in the yard, and there's going to be buyers, but less of them. And the buyers are going to say stuff like, well, we're at the top of the market. And the guy's going to say, okay, I'll give you 50 grand off. And then the other guy's going to say, I'll give you 75 grand off. And then it's 100 grand off. And then, next thing you know, more signs are in the yard, and it's becoming more of a competitive market. So right now, or, previously, it's been a seller's market, okay? Because it's been low supply, high demand, inflationary environment. Price values have been going up. It's a seller's market. But right now, we're at the shift of where the seller's market changes to the buyer's market. The buyer starts to dictate price and control the market, okay? And that happens once a lot of real estate signs start going in the yard, and there becomes a selling war to the downside. And homes like mine can lose 100 to 200 grand a month. And like no problem, like easy, okay? So the reason I'm selling mine, just so you know, is because I'm making a power play. I bought my house cash, just so you know, and it's gone up $1 million or more since I bought it. And so I put my cash into the home to let it appreciate, because I've been in real estate for a long time. I've been a developer. I've been on the lending side. I used to sell $40 million in mini bulk on the secondary market. I know a lot about finance and real estate, and I love it. I love it. I love stocks, crypto, and real estate. That's my thing. It will be forever. That's my thing. Okay? And I've made a lot of money in real estate. I understand it very well. And I also understand the cycles and the recessions and the environments and the phases. And when the bidding war starts happening and people feel that their last hope and last amount of wealth is in real estate, they're going to sell it. And eventually the more signs go in and they sell faster and faster to the downside. And then a lot of those people don't get to sell and now are underwater. They end up missing payments because they've been laid off. They have no money in equity. They're looking at going homeless. It's a shame. They get foreclosed upon because the banks don't care unless the government steps in with a moratorium, which could happen. And it has happened in the past under Obama. And it was called the Affordable Home Care Program, or Affordable Home Act, or something of that nature. And that was right when Obama became president, and the Lehman Brothers thing happened, and it was Bush, right? We were in the war, and then Obama came in, and he stepped into just a shit show, and then the Lehman thing happened, and we had a major financial crisis. It hit the real estate market hard. I don't think we're going to have it like in the financial crisis. I'm not saying that. I don't think the stress on the banks are as high. However, some of the large banks came out 2 days ago and said that they're kind of at the point of stress on their stress test. And these are the things you have to pay attention to. So if people try to sell lower to get out because they've been laid off and it's their last hope, and there's a bidding war to the downside, and some of those people do not get to sell and they're underwater, they get foreclosed on. Guys like me that have a lot of cash and sell their home and are cash heavy going into this environment, wait for the bottom. They're on the right side of the recession. They're very cash heavy going into it. Okay, they make a sacrifice by selling a gorgeous home, but they know that when they hit the bottom, they'll have a lot of money. And what my plan is I'm probably going to buy somewhere from 30 to 40 homes, $400,000, $500,000, $600,000 homes, and I'm going to put $100 grand down on each one. Okay. And I have very good credit, and I will basically just, get like fixed products, and I will wait for the real estate to bottom. And what happens is, like I've been telling you, the Russell goes first, the small cap, then the Nasdaq, the high multiple growth, and then the SPY, then the Dow. And the Dow is a leading indicator. It leads you into a recession. Okay. And by the way, the Fed Playbook, the entire thing is to bring down inflation, protect the world reserve currency, and they are purposely putting you into a recession. They have to do it. Okay. It's what they're doing, and they're doing it on purpose. Okay. They have to do it. It's just how they're going to have to get it out. But here's how it works. After they crash the stock and crypto market, and after consumer spending slows, which it already has, and after the hiring freeze, which is happening now, and then the layoffs, and then the real estate debacle that's coming, you're in a recession. You have slower growth in GDP. Okay, that's already happening. And one of the little tricks that they'll do is they will revise their estimates lower for GDP, and I noticed that they have already done that. It's just a little tricky move. It's a political move, basically, to, they lowered it a lot. I mean, it's ridiculous how much they lowered it, their estimate. So they're basically saying, no, we're not going into a recession, but they're lowering their estimate so far down that it's like blatantly, like if you just know how to read these things, it's saying, dude, we're in a recession. So, and that's just probably they're doing that because it's political for the midterms. But speaking of that, when you have a president go on Jimmy Kimmel, a late night television show, to plead to the American public, because what is it? It's 85 or 87% of all Americans disapprove of President Joe Biden's job with the economy or something. It's a staggering number. I mean, it's like in the 80s, 85, 80s. It's really, really high. And they were even making, they were even like kind of laughing about it on Bloomberg. Like, yeah, presidents don't usually go on the late night talk shows to plead to the American public. I mean, the guy's in trouble, right? I mean, so, and just a little friendly reminder about your friend Joe Biden. He was the vice president the last time we had a recession. So yeah, people remember that, he might not be always part of the solution and part of the problem. And he likes to tout about all these things he's doing, but for like when you're smart and you know how things work, you realize that it could be done better. Let's put it that way. So here's the deal. It's the Fed Playbook. This is how it happens. My goal is to be extremely cash heavy, and I will continue with the YouTube and the Discord. I love my students. I love it in there. And, I will be looking to get myself a nice house. My daughter wants a pool. So we'll get a 6-bedroom house, and, with a pool, and it'll be nice. And maybe it costs me $5,000 a month or something. And maybe I put 1-2 years down, and I just lump sum and give them $120,000, and we're rent free. And then maybe we're talking about maybe pulling our kid out of school for like a year, and we might just go to Hawaii and Airbnb there for a month, and I can trade from anywhere, crypto and stocks. So as long as I have Wi-Fi, we're also talking about maybe going to Europe for a couple months, and Spain and Italy and Greece, and some things like that. And as long as I have Wi-Fi, I'm cool, so I can do YouTube and I can trade. But the goal is to mitigate risk, capture those gains, sell at the top of the stock market, sell at the top of the crypto market, sell at the top of the real estate market. Humble yourself a little bit, hold the cash, go into the environment right, understand the playbook, and make a power play. And the power play is to trade the bear in and out with tight exit rules, okay? Capture your gains. And then when it does bottom, you buy the bottom of the stock market, you buy the bottom of the crypto market, and you buy the bottom of the real estate market, and you do it heavy. Because the biggest wealth transfer ever in the history of America was the people that did that, not crypto, but real estate and stocks, after the financial crisis, okay? So these guys came in, and instead of the ones that were getting laid off and foreclosed and bankrupt, they were the ones that were cash heavy and putting the yellow signs at the freeway and everything saying, I'll buy your house for cash. And they were coming in, calling up the banks, saying, what do you got for REO tapes, and buying blocks of 10, 20 houses at a time, and, you know, sight unseen, and they come in, and, you know, it'd be like a foreclosure, and, you know, somebody might owe, you know, it was worth 800, it dropped to 400, they owe 450, and you come in, and maybe you throw an inspection and an appraisal, and you bring over a GC, a general contractor, and you say, look, I'll pay you, I'll offer you 350, you know, I'll offer you 350, and I'll offer you this on this one, and this on this one, and this on this one, and you're paying a little under what they're losing. So they're going to lose a little at the bank, but they're going to get a lot of that money back at the bank, and mitigate their losses. And they will be willing to do that. Bank of America, all kinds of banks. Oh, I've done it before. All kinds of banks will basically say, okay, well, you know, I'll just walk you through it again. The homeowner owed 450. The home is now worth 400. They can't make the payments. They haven't made the payments for 6 months. Therefore, they're foreclosed. Okay. The bank still has the debt of 450. I come in and I say, what kind of inventory do you have? And they maybe have an auction, or they, you know, you get in with them, and you go look at the house, or maybe you don't even look at it. You're just, you know, whatever, you're just investing in them, and you basically offer them a little bit lower. So they're owed 450. Maybe you offer them, you know, 375. So they're going to lose 75 grand, but they're also going to have 375 grand back of their losses. And if you do that times 10, 20, 30, 40 houses, yes, they do take a loss. Maybe they take a loss of, you know, $2.5 million, but they were at a loss of 30 million, if that makes sense. So, or whatever the numbers are, but they mitigate their loss. You get a good deal. Now you got to do the fixing, and, you know, and you know, go get loans on it, and then get renters and become passive income. And there will be renters, because in the end, the rest of the playbook goes like this. Okay. So after the recession, I'm going to put a space here. So, oops, sorry about that, guys. So after the recession, what the Fed does is the Fed lowers the interest rates, and it's the beginning of a new QE cycle. Okay. I think I forgot a letter in there. Okay. So it becomes an easing cycle. And what that ends up doing is, when they lower the rates, it becomes more affordable for people to buy homes, to buy cars, to borrow money, and to put that money into stocks and crypto. And basically, businesses can start businesses and hire more people, and all these things that they have to do to bring inflation down and bring price stability starts to reverse. Okay. And when that happens, you'll notice on the real estate market, it will inflect and change the other way. As rates come down, it'll change. It'll start to change, just like it's changing right now, from a seller's market to a buyer's market. It'll change from a buyer's market at the bottom, or am I saying that right? Yeah. So at the bottom, it's, you know, you're going to want to start to buy the homes, okay? Because rates are going to come down. It's quantitative easing. Things are going up. And when that happens, you want to be cash heavy. You want to be prepared. And if it takes some time, which it's going to, just so you know. So typically these things take, I mean, how about I just show you? Okay? We're already on an index. I can just show you with an index. So let's go back to, all the way to 2008. Okay. It's right here. It's this yellow box. Okay. So this is a really good visual representation for you guys to just get an idea of the length of time. Okay, I'm gonna show you what you could expect at a worst case scenario. Okay, not exactly what's gonna happen, because I don't think all the parameters are the same, And I don't think that it's going to be identical. As an example, you can see from top to bottom, it was in the stock market a decline of 55.97%. I don't think we're going to decline 55.97%. I do think that we're going to decline more, and I do think we'll probably go to the peak of COVID before that drop, which is still down a little bit. Okay. During this time, we had the real estate crash. So from here, okay, from here where it started to fall, okay, to the time that it started to go above was February 13th, 2012. And that was from November 5th, 2007. Okay. So you have from 07 to 08, 9, 10, 11, 12, okay, plus 5 months. 5 years and 5 months. That sounds about right. That is pretty accurate. I think it'll be a little bit less than that. So what I think is going to happen is starting now for about 18 months to about 2 years, the real estate market's going to come down. Now, the stock market comes down 6 to 8 months prior to the real estate market coming down. So just so you know, we're on month 7 of the stock market coming down. Okay, we're on month 7. So in history, real estate always comes down after the stock market, and in this type of environment with the rate hikes and God, I can't get my chart. Sorry, guys. And it's 6 to 8 months after the stocks. The stocks are kind of like a leading indicator before that. So this started right here in November. So November, December, January, February, March, April, May, June. That's 7 months. So if real estate crash starts to go down 6 to 8 months and we're at month 7 and we are inflecting on all the reports, it's following history perfectly. Now, it took 5.5 years to get back to even. So let's say, the house is, worth, $3 million. Okay. I either sell now or I have to wait maybe 5.5 years to sell at the same price it is now. And selling now while it's still going up before it peaks and comes down is smart, because once it starts to come down, so do the values and so do all those signs in the bidding wars. So yeah, it sucks, but I mean, this is the Fed playbook. They're going to get what they want. You're not, unless you outmaneuver and you understand this stuff and you're willing to take sacrifice and you're willing to be vigilant and disciplined and smart about it. And I'm trying to look at it positive. I would rather never sell this house, actually. But because I put a lot of money in to protect my money and appreciate my money, which I have done, now I could lose all my appreciation and some of my principal, and that's just not smart investing. When real estate and stocks go parabolic, you got to have rules and a system to get out. When real estate goes parabolic, it's the same thing. We're at a top. When you're at a top, you gotta get out. And if you know that 6 to 8 months after the stocks crash, real estate crashes, and your house just went up $324K last month, yeah, you're at a top. You gotta get out. And a little bit of traveling with the family and focusing on getting ready to buy all the bottoms. Be a pretty big power play. And I'm in my 40s. In fact, I'll be 45 this week. It's my birthday in 2 days, I think, and it's tomorrow or the next day. I don't know. It's very soon, and I'm getting older, right? So I just feel like if I can go buy 30, 40 homes at the bottom and put a lot of money into the stock market and crypto market from the bottom into more of a ribbon buy and hold above the 200 kind of bull run scenario, and the greatest financial wealth transfer in the history of America took place the last time one of these happened, well, I'm going to try to get mine. So that way, by the time I'm 15 years up the road and I'm 60, well, I'm not worried about anything. Okay, I'm sitting on I want to get to I'd like to get to 40 million is where I'm trying to go by then, and it's possible, but it's only possible if I'm smart and I sell tops and I make really smart moves within, And so that's what I'm doing. I know how the Fed playbook works, and I know that I'm just one little guy, and I can't fight the Fed. I can't fight the consensus, and I can't fight the trend. Tomorrow when CPI comes out, this cloud is probably going to close, and it's time to make decisions. I'm going to hold on to my gains, and I'm going to get ready to do triple leverage hedging or going short. Probably just do the triple leverage hedging. It's just so much easier, and the gains are so much faster. I hope that you guys learn from this channel. I hope you subscribe. Come in the Discord. Let me teach you. I do mentoring, one-on-one coaching. You get my trade alerts. I'm on top of everything all the time. I mean, this is what I do. I live and breathe stocks and crypto, so I'm really on top of it. Plus, you're in a cool community. Everybody's cool in there. Discord link is in the description. Just click it. Make sure you have Discord on your Android or your iPhone. Verify with the phone number, the email, and then you're in. Go to subscriptions. It's $99 a month or $665 a year. You're gonna love it. You're gonna learn so much. It's gonna be so worth it. And then it's gonna open up the elite area, the Jedi Council, the Wheelhouse Wednesday area, the voice chats, and the Jedi area where everybody talks. You'll see everything in there, and I'd love to meet you. You could set up the one-on-one coaching with me, and I can help you as long as I know a lot about the topics, which would be more in the financial world. And business world. I've owned a lot of successful businesses. But yeah, come on in, and I appreciate you watching to the end. My name is Chris, and welcome to the Wheelhouse.